Of the day. I hope very well. So today we're focusing on the debrief for the FR pre-December 2025 mock. And I'm focusing on the section C. So you can see the first question there we have is Panama Company. And as usual, the first thing you do, start by reading the requirements, isn't it? So what does the required say? It's just one thing for 20 marks. It's saying prepare the consolidated statement of financial position of Panama at 30th June 2017, 2020, yeah, 2017, 2027 is not there yet. Okay. So Panama Company operates in the manufacturing sector. On 1st March 2017, it acquired a 75% interest in a supplier, which is Trilby Company, in exchange of 200,000 cash and one of its own shares for every 4 shares acquired in Trilby Company. The SOFP of the two companies are given to us at 30th June 2017. So remember, if you can see the dates, the first thing, always have your dates marked in mind. This is the year end is 30th June 2017 for both the companies, but the acquisition was a mid-year acquisition. It happened in March 2017. Okay, so we're going to have to do some adjustments, perhaps based on those dates. So we have the SOFP of both the companies given, and then they've given us additional information in the notes. The first note is about investment in Trilby. They said it's cash consideration. They said they recorded the investment in Trilby at the amount of the cash consideration. So if you look here up, under non-current assets of Panama Company, you can see investment at 200,000, isn't it? Which is what they paid as cash, but that's not the full amount, because they've missed the share entry. So they've told us at the acquisition date, the market value of a Panama Company share was $10 and the market value of a Trilby Company share was 5.9. Both the companies have a nominal value of $1. So we're going to have to calculate the share consideration and then, of course, use it in our goodwill working. Note 2 says that the Panama is elected to measure NCI as a proportion of net assets method. So not full goodwill method, okay? Be careful. At 1st March 2017, Trilby Company's property had a fair value of 36,000 in excess of its carrying amount. The property had a remaining useful life of 20 years. So remember, fair value adjustments, we're going to adjust it in the working one at acquisition date. Since this is a depreciating asset, on the reporting date column, we're going to adjust it after computing depreciation. And also, when we do our SOFP, consolidated SOFP, we need to increase the value of PPE by the at reporting date adjustment that we did, right? And then note number 4 says that in the year ended June 2017, Trilby Company made a profit of 33,000, which accrued evenly across the year. This was considerably lower than in previous years. Panama Company directors were aware that Trilby was struggling to control costs, and prior to the acquisition date, they had already decided to restructure Trilby's business to eliminate a layer of management. This would incur expected redundancy costs of 60,000. The restructuring plans were announced to Trilby Company staff members on 20th March 2017. The restructuring will commence in July 2017 and will be completed by December 2017. The intended restructuring costs are not reflected in either company's financial statements. Now, remember when we did the topic of provisions, we said that if there is a restructuring and the plans have been communicated to the affected persons, then we need to make a provision for restructuring on that date, okay? And we've been clearly told that the restructuring plans were announced to the staff members. So they've been communicated to the relevant people on 20th March 2017, which is just right after the acquisition, isn't it? So that, and they said that the intended restructuring costs are not reflected in either company's financial statement. So at the acquisition date, 1st March, there was no restructuring provision required because this plan was announced after on 20th March 2017. So when we do the at reporting date column, we're going to have a provision for restructuring, and provisions are liabilities. So the liability is going to reduce our net assets at reporting date column. So keep that in mind when you're working through your working one, okay? And then of course, they said them also in that very note number 4, they had said that the profit was 33,000 and it accrued evenly through the year. But remember that we've only acquired this company in March. So we'll need to calculate the profit for the year ended 30th June. I mean, retained earnings are given, but then we need to do a backward calculation to get retained earnings at acquisition by simply subtracting the post-acquisition profit, isn't it? Then note number 5 says, throughout the year ended 30th June 2017, Panama has bought $8,000 goods from Trilby every month. Trilby makes a markup of 25% on these sales, and at 30th June 2017, Panama still held all of the goods brought in May and June. So 2 months are still there. So expect unrealized profit. And it said that it still owed Trilby Company for all the goods bought in June. Now here, be careful. They've said that it only owed Trilby Company for all the goods bought in June. So when you're doing your subtraction of intercompany receivables and payables, you're only going to subtract 1 month. Don't go and subtract everything because it's only 1 month, the June one, which is an intercompany receivable in one book and payable in another. And we're going to have to compute the unrealized profit on the goods, the unsold goods, which were the ones in May and June. So 2 months of sales have unrealized profit on them. And unrealized profit, remember, is added to group closing inventory, and it also affects retained earnings depending on who the seller is. Who's the seller in this case? Panama, the parent, has bought from Trilby. So since Trilby is the seller, unrealized profit is going to be adjusted as a reduction in our net assets at reporting date, working one, isn't it? If it was the parent who was the seller, it would be adjusted in the group retained earnings, the consolidated reserves, working number 4. Next note says Panama acquired its investment property on 1st Jan 2017. The property cost $144,000 and had a useful life of 50 years when it was acquired. Panama's directors have decided to adopt a fair value model for investment property and have been advised the fair value of the property is $170,000 at 30th June 2017. So they bought an investment property. When they bought it, it was $144,000 and the fair value has gone up, and they want to use the fair value model for investment property. Fair value model for investment property, the fair value changes are taken to P&L. Now here the last line says that other than recognizing the property at cost, no accounting entries have been made. That means the increase in fair value Panama, which is the parent, has not reflected the increase in the fair value of the investment property in its books. Now, if it's taken to P&L, how is that going to affect us here when we're doing the consolidated SOFP? It should have been taken, the difference between 170 and 144 should have been taken to the P&L. P&L calculates the profit, so profit would increase retained earnings. It's an upward fair value adjustment, isn't it? So it would have, it should have increased the retained earnings of Panama. So here, when you're doing your working number 4, the group retained earnings, be careful, you must increase the group retained earnings by the increase in fair value of the property, okay? Because I've not done the accounting entries for it. They've clearly said that. Okay, those are our 5 adjustments, 6 adjustments, not heavy. So let's begin. It's only one requirement, preparing the consolidated SOFP of the Panama Group. So we come right here in our cell, Panama Group, consolidated SOFP as at 30th June 2027, 20x7, okay? So we know our workings, but then what we're going to do, we can simply go on the side because we'll be putting our main SOFP there, okay? So I'm going to come to the side here and we follow the order we've learned in class. Working 1 was net assets of subsidiary. Net assets of subsidiary, we must have our net assets at acquisition. Net assets at acquisition. Then we have our net assets at reporting date. And of course, the difference is post-acquisition, isn't it? So what's the first net asset? Always the first one is going to be share capital. Share capital, if you look at the subsidiary Trilby, share capital was how much? 80. This is also not the zeros, okay? These are 3 zeros. So I'm going to put an extra column there so that we tell them that we're also making our life easier. Okay, so in all columns, we'll put the 3 0. Okay, share capital was 80, and they've told us, yeah, there's no share capital change, right? No. So we put 80. The next thing, we have our usual retained earnings. Retained earnings at the reporting date, we can pick them out from the SOFP. You can see retained earnings is 371. 371 out there. But what about retained earnings at acquisition date? Because remember the reporting date, that figure is for June, isn't it? 30th June. Yet we want net assets on acquisition date was March. So what do we have to do? We simply, from this 371, we're simply going to subtract the post-acquisition profits of March, April, May, and June, 4 months. They've told us down that in the year ended 30th June, Trilby made a profit of 33,000. So what we do, 371 minus 33,000 divide by 12 times 4. We need to subtract the 4 months profit, isn't it? And so when you start with your reporting figure, you start with your retained earnings at the reporting date and work backward to get the acquisition date by simply subtracting whatever happened in those 4 months that changed the retained earnings. So you can see retained earnings at acquisition are 360. Again, as I usually emphasize, if you're not confident on the BODMAS, the brackets working, it's okay to confirm it on your calculator, or you simply type out. Don't put the equal to sign. Simply have an additional row there and type out your formula, and then you can calculate in your calculator and put the figure there. But that's only for longer, complex calculations. Don't do that for everything. Otherwise, you're wasting your time. You're not using the CBE platform to its advantage, which is basically time saving, okay? Next, after retained earnings, remember there was a fair value adjustment in note number 3. They've said that at 1st March 2017, which is the date of acquisition, the property had a fair value of 36,000 in excess of its carrying value. So fair value adjustment at acquisition should be 36,000. But since this is a depreciating asset, at the reporting date, the fair value is going to be different, because we need to account for the depreciation between acquisition and reporting date. Those are 4 months, as we already established just up in retained earnings, isn't it? So we need to basically subtract 4 months depreciation from the 36,000. So 36,000 minus 36 over 20. 36,000 over 20 is going to be the depreciation. But then we have to multiply that times 4 over 12. Okay. So, I didn't put the equal to sign there. So that's 35,400. 35.4, sorry. That's going to be the value of our plant at the reporting date after adjusting for the depreciation. Then we have what? What else did we say we need to adjust for? The unrealized profit, isn't it? The restructuring costs also. The restructuring costs, we said we have to create a provision for restructuring. Provision for restructuring. Restructuring. Right. So we said the provision was on 20th March, the day when they announced it, because that's when you have a provision, okay? You have a legal provision because you made the announcement of the restructuring. Now, what the amount is 60,000, so we're not going to put it on the acquisition date, we're going to put it on the reporting date. But what is it going to do to the reporting date? It's going to be a subtraction, because this is a liability. And we're doing net assets, which means assets minus liabilities. So liabilities reduce our net assets, okay? So either you put a negative sign and you put the figure, or if you're not going to be careful when you do your final totals, don't put the negative sign there, but remember to individually select the right things to add and subtract, as I usually emphasize. Okay, so this time I've used a negative sign there. Nothing on the acquisition date, so you can put there 0. And then next, we have our unrealized profit. We established that it is the subsidiary selling to the parent. So unrealized profit should be taken out from the subsidiary, isn't it? So unrealized profit, our URP, nothing at acquisition, but then in the post-reporting period, they've told us that Panama company still had all of the goods brought in May and June in inventory. Each month they were purchasing goods worth 8,000. So that means they have 8,000 for May and 8,000 for June, 16,000 of goods still in inventory. And they have told us that Trilby makes a markup of 25% on these sales. It's a markup and we have the sales value. So whenever you have markup and sales value, what's the formula? 25 divided by 125 times 16,000 is equal to 25 out of 125 times 16,000, which is basically 8,000 May, 8,000 June, isn't it? So 3,200, but oh no, I'm going to reduce the zeros in 16. I'm going to keep them at 16. There, 3.2. Unrealized profit is also subtracted. It reduces our net assets, isn't it? So I'm putting a negative there. Again, if this confuses you, don't bother about putting the negative signs in this. Just remember when you do the totals, remember what to add and what to subtract. So unrealized profit was 3.2. And the next adjustment was about Panama, the parent. And these are net assets of the subsidiary. So we're not going to adjust for that here. So all we do is that we get our totals. The sum there So net assets at acquisition date were 476,000. And I'm simply going to drag this. I'm not going to repeat the formula. I'm simply going to drag this there. So that's 423.2. So here, post-acquisition column, I have not put the in-between figures. We just need the final, okay? So it's going to be the one at reporting date minus acquisition date. So you can see that in the post-acquisition period, there has been a reduction in net assets of 528,000, 52.8, with of course the 3 zeros up, okay? So that's our working one done. The next standard working we have is working two, goodwill. Goodwill, remember, they've not included the consideration of shares, so we'll first have to work out the consideration. So cash consideration, we know, put it in this column. Cash consideration was 200,000. Shares, the share consideration, let's go back and read how much was for shares. They said that they acquired 75% interest in a supplier, which is Trilby, in exchange of $200,000 cash and one of its own shares for every 4 acquired in Trilby. So first of all, what's the number of shares acquired in Trilby? Let's put that on the side there so that we do a working. The number of shares acquired is going to be 75% times, if the share capital of Trilby is 80,000. And remember here, they've told us that both the companies have a nominal value of $1. So this is $80,000 reflecting 80,000 shares. So the number of shares of Trilby that were acquired was 60,000. And the share consideration you gave was 1/4, one of its own shares for every 4 acquired. So that's a 25%, 1/4, right? So shares issued is going to be 1/4 times 60,000. And then value, if you are okay to do it all in one cell, again, that's fine. I'm just doing it the longer way so you see and you don't mess up, okay? We were told in note number 1 that the value, don't pick the value of Trilby shares. It is Panama issuing its shares in exchange of getting a 75% stake in Trilby, right? So we need to pick the $10, the market value of Panama shares. So 10 times 15,000 shares. So the share, the value of the share consideration, I should have put that formula here. So I'm going to reduce the number. I'm going to reduce the number of zeros. Sorry, 60. Keep our working standard, right? So the value is going to be 15,000 times 10. So 150,000 is the value of the share consideration. So total consideration is going to be 200 plus 150. But we need to put for the examiner there that we are using the 3 zeros. Okay? So he knows that. Then this is proportionate method, right? They said note number 2 says Panama has elected to measure the NCI as a proportion of net assets. So we're not going to add NCI there. We simply subtract less fair value of net assets, P's share, parent share, of fair value of net assets at acquisition. How is that going to be? We know parent share is 75%, and we've already computed net assets at acquisition up here. We pick the net assets at acquisition figure was 476, right? So 75% of 476 gives us 357. Now, what can you see here? We paid 350 to acquire a 75% stake in this company, but in return, the assets we got were worth 357. That means this is a bargain purchase, negative goodwill, okay? Bargain purchase is going to be that, because we know the formula for goodwill is that consideration minus fair value of net assets, right? Negative 7,000 is the goodwill. Negative goodwill is not reflected in your SOFP, in the consolidated SOFP, but rather where does it go? It goes under retained earnings, the group retained earnings as an increase, okay? Because you got a discount. Good thing for you. So that's your negative goodwill out there. That's your working 2 done. Our standard working number 3 is NCI. NCI is going to be value of NCI at acquisition. We were told that NCI at acquisition is going to be a proportion of net assets. We know NCI is 25% because parent acquired 75%, isn't it? So NCI at acquisition will be 25% of the net assets at acquisition, which were 476,000. Simply do 25% times 476 gives you 119. And to this, we add plus NCI's share of post-acquisition reserves. Okay. So what's the post-acquisition? What happened in the post-acquisition period? 25% of that goes to our NCI. And we know that in the post-acquisition period, they went down. The post-acquisition was a negative 52.8. So that means that the value of our NCI is going to be 119 plus negative 13.2, which gives us 105.8. Okay, as usual, I've reduced the zeros, so I'm putting the 3 zeros there up. That's your simple NCI done. Working for is going to be our group retained earnings or consolidated reserves, as whatever you like to call it, okay? So group retained earnings, we're going to start with the parent share of, parents retained earnings, P's retained earnings. How much was P's retained earnings? 518, as you can see from the SOFP there. 518. To this, we're going to add P's share of Trilby's T's post-acquisition reserve. Just like we gave NCI its share, P also has to get its share, but this is a negative, right? 75% times what we calculated in the post-acquisition column of working one, the 52.8. So P's share of post-acquisition reserves, P gets its negative, its negative 39.6, isn't it? And then the next thing, remember we had a bargain purchase. So bargain purchase was 7,000. We can tell the examiner this is from working number 2. I'm not picking it out because it has a negative sign, yet the 7 is going to be an increase, okay, for us. It increases the group retained earnings. And then what else is left? We had our note number 5. Note number 5 said that the investment property, remember we discussed it, they have not yet accounted for the increase in the fair value of the investment property. So we need to do that. So increase in fair value of investment property is going to be 170, right? The value at the end of the year minus 144. So that's going to be 26,000. And when you total that up, that's it. That we've adjusted for all the notes now. The URP was in the subsidiary, so that would have already been accounted for when we did B's share of subsidiaries reserves. So we just have to do the sum of these figures. And that gives us the group retained earnings as 511.4, isn't it? Then all we're left to do now is to put this in our final working for the group. So let's begin doing that. So let's put our sign there. Starting with our non-current assets, NCA, we have property, plant, and equipment. So we have, okay, let's put the zeros first. Okay, PPE, we have 480,000 for the parent, plus 457,000 for the subsidiary. And remember we did a fair value adjustment for property. So we need to pick the figure at the reporting date, okay? You see the 35.4 after accounting for the depreciation. So you're going to put there plus, and you simply go and cell reference it there. But also on that note, put there working one, so that the examiner knows where you picked that figure from, okay? The part of the figure from. So that's 972.4. And then the next we have is investment in property. Investment in property, remember the parent had The parent had an investment. Initially, you can see it's been recorded at 144, but just to remind you, the note number 5 said that that property's value is now 170, isn't it? So we're going to put there 170,000, basically. You can just pick that figure there. So the sum there, is there anything, is there the next thing that will come there is goodwill, but in this case, there was the negative goodwill, so you don't have to account for that. Oh, why has it become 10 there? And investment in Trilby, 200. Remember, the investment in Trilby is not included. It's cancelled out because of the consolidation working. So all we have to do is get the total now of our non-current assets, which is going to be 1142.4. We move on to our current assets. Current assets, we have inventory. Inventory is going to be 63 for the parent, 42 for the subsidiary, and remember there was unrealized profit, isn't it? Unrealized profit reduces the value of closing inventory, so go there and simply pick. Okay, so since I put a negative sign there, you see I couldn't put a minus there, so I'm going to put a plus. If I put a negative, negatives cancel out each other, isn't it? So be careful. So that's going to be your inventory at 101.8. Then we have our receivables. Also, let's tell the examiner we're picking up a figure from working one. Then we have receivables. Receivables are going to be 41 for the parent, 24 for the subsidiary. And remember, there was intercompany sales, but they said, let's take you back to that note. What did they say? That was note number 5. They said that it's still owed Trilby company for all the goods bought in June, isn't it? Sorry, that's a bit of a background noise, but it's still owed Trilby for all the goods bought in June. So only 1 month of receivables, intercompany receivables and payables were there. So there's no cash in transit also they've told us about. That means the only adjustment we need to make for receivables is not the total amount, only what is owed, which is 8,000. Okay, so minus 8,000, because why minus? Because we are eliminating intercompany receivables and payables. So our receivables are at 57. What else is there under current assets? We have cash. Cash is only 10 for the parent, nothing for the subsidiary. Was there any adjustment to cash? There was no adjustment to cash. There was no cash in transit, like I already said. So we then get the sum is equal to sum of all our current assets. That gives you current assets at 168.8. So our total assets are going to be our non-current assets plus our current assets. That gives us 1311.2. We now move on to our equity section. Equity section has share capital. Remember, only include share capital of the parent, not the subsidiary, right? Share capital of the parent is 100, but if you recall, there was a share consideration that the parent did not record, right? When the share consideration that we computed here. So the shares issued were 15,000 new shares. We've already computed it there. And that was in working 2. So let's put it there. So we issued 15,000 new shares. And remember, they've told us that the nominal value of each share in both companies is $1. So $15,000 there, increasing the share capital of the parent because of the share consideration. Share premium? Oh, no. Share premium. Again, you only take the share premium of the parent. So originally it was 35. Now we have issued 15,000 new shares, isn't it? So 15,000 new shares, and look, they've told us in note number 1 that the market value of Panama shares was $10. So when we would have issued the shares, the share consideration, it would have been at that price of $10. We've taken $1 up in the 115,000, with 15,000 shares times $1 as the nominal value. So here, we need to multiply this by 10 minus 1, the premium amount, which is $9. So our share premium account increases, it becomes 170. Is it 170? No, what have I done? 35 plus 15,000 shares times $9. So that's going to be Right. Okay. So 15,000 times, okay, 170 there. And then we have what? No, hold on. Okay, so yeah, share premium standing at 170. Then we move on to retained earnings. So group retained earnings, which is going to be a working what? We've done that as working for, right? Working for, oh no. Group retained earnings, working for. So there, put the equal to sign and pick whatever we calculated in working for. So 511.4. Okay, get the total there now. So that's 796.4. Then we have our NCI, which we did in working 3. NCI is going to be is equal to, then simply go and pick the NCI figure we did there of 105.8. Okay, so that gives us the total of 796.4 plus 105.8. That's at 902.2. We then move on to non-current liabilities. Non-current liabilities, there's no adjustment really there. We just have to add across, is equal to 180 plus 40. That's going to be 220. And then we have current liabilities. Current liabilities, again, is going to be 105 for the parent plus 32 for the subsidiary. And then we're having two things. We're having two things under current liabilities here. First of all, if you recall the provision, they created a provision for the restructuring, isn't it? And that figure was, they've given it to us here in which note? In note number 4, the provision was worth 60,000. So we need to increase the current liabilities by 60,000. And remember the intercompany payables, we subtracted 8 under receivables. So we have to subtract 8 from payables. And that's it. That's our last adjustment. So all we now have to do is to total. So get the total of 902.2 plus 220 plus 8189. 1311.2, are we matching 1311.2? Yes. So we are done with our consolidated SOFP for the group, and that's your 20 marks. Okay, so that was the first question of our section C there. We now move on to the next question. The next question is, okay, see, if you don't scroll down, it says you viewed the entire screen, so it wants me to scroll down basically. So that just to make sure you don't miss any information. Okay, so our next company there is Corrig Company. And let's read the requirements first. We've been asked to calculate the equivalent ratios to those listed for Corrig for the year ended 31st December 2016. That's 4 marks. Usually they've given us the equivalent ratios, right? So if you look down, you'll find the equivalent ratios. So they basically want us to recalculate all these. When you see there are 4 marks, and it's usually half a mark per ratio that the examiner gives. So there must be around 8 ratios here. That's why that's 4 marks. And then the next part is obviously asking us to analyze and comment on the financial performance and position of Corrig Company for the year ended December 2016, which is going to get you your 16 marks, the interpretation question. Okay, so let's read through. We've been told that Corrig Company is a clothes manufacturing company with a majority of its revenue generated through sales to fashion retailers. That's an important paragraph because it tells us what the business is about, and that does affect our analysis. Okay, they've also told us that it summarized financial statements and ratios for the year ended 31st December 2016, and the comparatives for 2015 are given to us. So you can see the SOPL for the year ended 2015 and 2016 is given to us. Now, if you just have a glance at this, if you look at the revenue in 2015, it was 72 million, and then it goes down to 59 million. Cost of sales is also decreased, but not in proportion to the revenue. So there's something going on here. When we read additional information, we will be able to figure out the reasons for this declines, okay? You can see that the gross profit has also fallen quite drastically. Operating expenses have increased, and the operating profit of 2015 has turned into an operating loss in 2016. There's also a loss on remeasurement of financial assets through P&L. You can see the FVTPL is fair value through P&L. it's in brackets, so there's a loss, and they've told us it's a loss on remeasurement. Then profit before financing and income tax. In 2015, it was a profit, but this is now a loss before financing and income tax. If you look at the interest expenses of 2015, they were 0.9 million, but they've increased. The interest expense on borrowings have increased to 1.2 million. And then profit before tax, it's a profit of 9.7 for 2015, but a loss in 2016. Income tax, since there was a loss, there's a loss relief in 2016, but there was there was a income tax relief in 2016, but there was income tax of 2.6 million in 2015. And then you have the profit of 2015 has entirely converted into a loss. And we can see the revaluation reserve is also down. It's at a negative, okay? So that indicates a downward revaluation on our assets. And we have total comprehensive income, which has turned from a positive 7.1 to a negative 12.1, as you can see. So if you look at the SOFP, of course, they've given you the figures there. And then they've told you the following information has been provided by the company directors who have publicly announced that Qorix company's performance has been affected by the overall economic recession. So do those figures make sense now? There's been an overall recession, we've been told. And the directors have publicly announced that, yes, the performance of the company has been affected. But they've also said that the company has shown resilience despite the costs mentioned below in the notes. The first note says that Qorix factory building has suffered impairment or revaluation losses of 11.5 million in the year ended December 2016. The excess of these losses over previous revaluation surplus has resulted in a charge to cost of sales of 2.5 million. There were no additions to or disposals of PPE during the year. So that explains this reversal. You see the revaluation reserve. There has been an impairment. And remember, impairment on previously revalued assets, you first take away whatever is there in the revaluation reserve. That's why they've reversed in the entire 9. And they said the excess was 2.5 million above. The excess of the impairment above the revaluation surplus was 2.5 million, which they said is taken to cost of sales. So that explains why the cost of sales has fallen from 53 to 51. But if you see, revenue fell from 72 to 59. So it's not really fallen in those lines. And that is explaining the impairment losses, is explaining that why the cost of sales is still standing at a high, okay? Then they said, the next note says, so all these, while you read these notes, it should strike you as to what this would impact. So that's why, because of this impairment, you expect the gross profit to be low. But again, remember that impairment could be a one-off thing. You know, it's not that every year your assets are impaired. So perhaps for this particular year, yes, the impairment has affected them, but maybe that won't be the case in the future, isn't it? Note number 2 says, as part of a cost-cutting strategy, the company made some senior and skilled employees redundant during 2016, incurring redundancy costs of 1.8 million. These are included in operating expenses. Qorix also reduced its expenditure on marketing and advertising, which is also included in operating expenses. So 2 things here. First of all, there's an increase in operating expenses because of redundancy costs of 1.8 million, but also the reduction in marketing and advertising costs, which is also going to be part of operating expenses. So if we look at operating expenses, last year it was 8.4, but this year it has increased to 8.7. So that could be because that could be attributable to the redundancy costs. But then remember, again, those are one-off costs. If you look at your SOFP, if you look at your retained earnings, the retained earnings were 12. No, not there. Note number 3. Okay, we'll talk about note number 3. We'll see a connection there because I'm seeing something to do with cash. But then because one thing, yeah, if you look at our SOFP, has there been any provision for the redundancy costs? If you look under provisions if you look under liabilities, we're not really seeing any liabilities as any provisions rather. So that means that those redundancy costs are paid upfront using cash, isn't it? And because they're paid using cash, that's why our cash is definitely going to be affected, but our operating expenses are looking higher. But like I said, this is a one-off thing, so you don't expect this to happen next year. So next year's operating expenses should be lower as a result of not having the redundancy costs. Of course, other factors matter as well. Now, this year they've saved I mean, they've not really saved, but then they've incurred the costs of redundancy. What that means is that next year they'll no longer have these employees, the senior and skilled employees. So what does that mean for the business? That quality may be affected, isn't it? And also, will you be able to meet demand? Perhaps there may not be that much demand because they said the economy is in a recession. However, quality matters. So are you going to be able to have the same quality of goods that you had in this time? Because your skilled employees have been made redundant. And the second thing is expenditure on marketing and advertising has reduced. So, of course, when you reduce your marketing and advertising expenditure, that could have an impact on revenues in the future, isn't it? Revenue has already declined this year. So maybe the reduction in marketing and advertising is a cause of the decline in revenue aside of the recession. And in the future, if you continue to reduce it, then future revenues will also look low. Then note number 3 said that the bank balance of Corrig has improved by 2.2 million and bank borrowings have decreased by 1.5 million as compared to the balances at the previous reporting date of 31st December 2015. So they're telling us the bank borrowings have decreased. Okay, so debt has reduced, isn't it? Debt has reduced, so that would have an impact on our gearing ratio. But if debt has reduced, if you notice, when we were reading through our SOPL here, look at the interest expense. In 2015, it was 0.9, but in 2016, it's 1.2. So if debt has reduced, why is interest expense going up? They've told us here that Corrig companies' bank borrowings are on variable interest rates. So that should explain it, isn't it? Perhaps the interest rates have increased because of the general situation of the economy. And that's why, despite the borrowings of the company reducing, the finance costs have increased. Then they said the company made a fully subscribed rights issue during the year to help improve cash flows. The directors reduced the dividend per share by 45% as compared to the previous year. So fully subscribed rights issue, that means all your investors took up the rights issue. So that can also explain how the bank balance increased. If they have repaid their borrowings and the bank balance has improved, that's definitely because money has come in through this rights issue, which at this time is good because at the time of recession, when results are going down, it shows investor confidence in the company, isn't it? That they're still willing to give the company money despite results not looking so good in the current year and despite the fact that the economy is in a recession. But they've said that the directors reduced the dividend per share by 45% as compared to the previous year. So that means that they still paid a dividend per share of 55% compared to previous years. If 45% is the reduction, they must have paid 55% of last year's dividend per share as this year's dividend. Now you could ask yourself, when the company is in a recession, there is operating losses instead of profits. Why is it really wise of the directors to still be paying a dividend, although it's at a reduced amount? Was it a wise decision? Perhaps they did that to reassure the shareholders and that, you know, we still have the potential as a company. But yeah, that's a point that you definitely mentioned in your analysis. Then they've given us the extract of the equity at December 2015 last year. You saw there's a positive revaluation reserve, which is the one they reversed in this year's SOPL, because that's why you see the 9 in brackets there. They reversed all of it. Then retained earnings were at 12. This year's SOFP, if you see, retained earnings are at 7.2. So this year there was a loss of 3.1. The starting retained earnings were 12. Then there was a loss of 3.1, so that would reduce it. And the closing is 7.2. The MAT there, the difference then is going to be the amount of dividend that you paid. Okay, so you can calculate that as part of your analysis. And then they've calculated the ratios there and given us for 2015. So coming to our requirements, the first requirement says recalculate these ratios. You're supposed to, sometimes, like I told you in the revision class, you may get a pre-formatted table. So they'll give you a ready-made table in the answer area that you have to fill. But if they don't give those to you, you can see that this is not an Excel sheet, okay? It's a Word file. So you're supposed to calculate ratios. In that case, you're supposed to show your working and the final answer. If you recall in revision, the format, the pre-formatted thing that was given to us, we follow the same. Even though it's not been given to us, we are going to follow the same. So we're going to insert a table, use this feature to insert a table. And you know, you can just use whatever the number of rows, columns you want, you can simply select and insert a table. But what I'm going to do to save us time, I'm simply going to show you an answer that I've already computed here. I could not copy paste this answer in that exam area, so it's on a different document, as you can see on the side. So this is a table that we want, and you can see that on the side, we're going to put all the ratios as they've asked us. Those are the ones we have to calculate. Then you need to have a column for the working, and then you put the 2016 figures, and then besides that, you put the 2015 figures for comparison. Those ones you just pick and put as is from the question. So gross profit margin, we know that gross profit margin is going to be our gross profit over the sales revenue. That's why you can see there the 8 million over 59 times 100. Operating loss margin this time is going to be 0.7, which is the operating loss. You can see that. Sorry, so 0.7 divided by 59 times 100. Return on equity. The return on equity is 3.1 divided by our equity. Equity is how much? You can see here the total of equity is 35.2. So 3.1 divided by 35.2, it's a percentage, so times 100. Then we have our net assets turnover, which is sales over our capital employed, basically sales over our PPE, total net assets. So sales is going to be 59 million divided by 35.2. Okay, that's your net assets turnover. Now here they've already given the formula, okay? Okay, no, not really. That's the formula in the answer. Okay, so net assets turn, I thought that was written, but they've given you the formula for gearing, which they usually do because it's either debt over equity or debt over debt plus equity. So here they've told us that they've used debt over equity. And so gearing is going to be our debt is how much is our bank borrowings. If you see 8 million divided by the equity, we know is 35.2. We've seen, we have that figure up there. 35.2, that gives us our gearing of 22.7. Payables payment period is going to be our payables. If you see, they're 6.8 from the SOFP, divide by our cost of sales, which you pick from the P&L of 51 times 365, because this is in days. Similarly, receivables collection period is going to be the receivables, which you see at 4.4 million, divide by our sales of 59 million times 365, that gives you 27 days. And inventory holding period is going to be your, inventory holding period is going to be your closing inventory. When you either use average inventory or closing, they've not given you opening inventory, so we have to use we can't do average inventory. So we use our closing inventory, which is 4.4, divide by inventory holding period is closing inventory over cost of sales, isn't it? So divide by 51 times 365. And that should give you all your ratios computed, half a mark each for each of the ratios. And then you have your 2015 comparative figures. Now, whatever I discussed in each of the points, we're going to put that in our analysis. Remember in class, I told you that you need to format your answer in the right way. So they've asked us part B, if you look at the requirement that said analyze and comment on the financial performance and position of CORIG. So we're going to put our heading as performance and position, starting by analyzing the performance. Which are the performance ratios? The ones, the P&L ratios is going to be our gross profit margin, net profit margin, and the operating profit margin, isn't it? So we'll talk about those and the reasons that contributed to those ratios changing. And then we will do our position, where we analyze the rest of the ratios and give a conclusion. So I put the answer there for you. I'm simply going to go through it because I didn't want to type it. The point is for you to understand, not for me to teach you how to type. Okay, so you can see CORIG's results. Clearly, first of all, you start by saying that, yes, the results are reflecting the effects of the recession, isn't it? Revenue has fallen by 18%. How do you get that 18%? You simply get the difference in the revenue, 72 minus 59, divide by the original revenue of 72 times 100. So revenue has fallen by 18%. And obviously, because that fell, the profits would be affected, both the gross profit and the operating profit. So gross profit is down by 58% based on our computations, okay? And what we computed is gross profit margin, but the gross profit, the change in percentage, you can simply get the change in gross profit divided by 19 million times 100. That's how I got the 58%. So gross profit is down by 58%. Operating profit has in fact turned into an operating loss. And last year's profit after tax of 7.1 million, the 7.1 million has become a 3.1 million loss. And as a result, remember return on equity, the return on equity also depends on the returns, the profit. So that's why our return on equity has also fallen. We calculated return on equity up. It has fallen from 15.7% to 8.8. So it's 15.7, not 4. Okay. So you basically start by giving an overview of whatever is related to the performance, and we've mentioned that. Then we talk about, now we talk about why it has fallen. Sorry, I was about to get a sneeze there. Anyways, remember when we were looking at the P&L, we saw that cost of sales has not really reduced in line of the revenue. So we need to mention that. Okay, and we need to mention the reasons why, which was given in the notes, which is basically note number 1 that we're going to talk about. So cost of sales is not reduced in line with the fall in revenue, and that's because of the impairment as we discussed. And also, aside of the impairment, we can't just conclude that it's all because of the impairment. We could also say that there may be other costs in the cost of sales, which may be fixed costs, or the cost of other resources may still be high, okay? So you've seen, I've mentioned that this is mainly because of the impairment of the factory building, and also because there may be some production costs, which are fixed, and raw material costs may be high. Marketing expenses have reduced, which may partly explain the fall in revenue. And that's why the gross profit has fallen. Okay, and I'm sorry, that's why when revenue falls, gross profit also is affected. And could also reduce future sales. Of course, like we discussed, marketing and advertising reduced. That means in future also, sales could be affected as a result of lower marketing and advertising. Then, so aside of what the examiner has asked you to calculate, you could go on and make your own calculations, okay? That gives you extra marks in the analysis. This analysis is 16 marks. So generally that's 1 mark for a valid point. So you must, and there's always ample. In ratio questions, all your answers are within the question. That's the beauty of interpretation questions. All the answers are within the question. You just have to find the right way to reframe the question as an analysis, okay? Of course, that doesn't mean you copy paste what is in the question. There, you have to write it in the right way. So if we are to do a further calculation, we can say that if these one-off costs of impairment, redundancy, if these are removed, and of course the loss on investments, isn't it? We don't expect those to happen every year. So if we remove that, maybe the underlying performance is better. So you can see that I went on to say that, however, the underlying performance is better once we adjust for the one-off costs of redundancy, impairment, and loss on investments, because these are unlikely to recur in normal conditions. And removing these costs can give you a more realistic picture of the performance. So if you exclude the factory impairment, remember the 2.5 million of the impairment was contained in cost of sales. So if I remove the 2.5 million, that means my gross profit will increase from 8 to 8 plus 2.5 gives you 10.5, right? So if I remove the value of the impairment, that means my gross profit margin improves. When you recalculate the gross profit, it's going to be 10.5 divided by 59 times 100. That gives you a gross profit margin of 17.8. And remember, the old gross profit margin, the one we calculated here, is 13.6. So yes, gross profit margin falls from 26.4 to 17.8, but it's still better than falling to 13.6. Then removing the redundancy and impairment costs gives us a revised operating profit margin. If you look at operating profit, it's currently at a loss, operating loss of 0.7. So if we remove the effects of redundancy and impairment, what happens? The redundancy costs were how much? We were told that redundancy was 1.8. So then operating profit would increase by 1.8. And similarly, the impairment costs, which affected our cost of sales, they also affect our operating profit, isn't it? So we add back those and to the operating profit. So that gives a revised operating profit. So instead of a loss of 0.7, it becomes a profit of 3.6 million. And then when you compute the operating profit margin based on that, it's actually looking much better than what we have here, this loss margin of 1.2, isn't it? So that's additional computations that you could have done to remove the effects of those one-off items. So this is still worse. The 6.1 is still worse than last year's, where it was at 14.7, but it's definitely better than the loss, the loss, isn't it? And so overall, now winding up the performance part, overall, considering the recession, these adjusted results are fairly strong and support management's claim. Management here was claiming, isn't it, when they told us that the company has shown resilience. So these results support the management's claim that the company is resilient. but we have a concern that the reduced marketing spends and the redundancies can harm the long-term performance of the company and create risks for the company, isn't it? So that's your performance analysis done. Then you move on to the position analysis. So we've seen that non-current assets have reduced because of the 11.5 million impairment on PPE. Of course, the non-current assets are going to be affected by impairment. And also the non-current assets have been, they're going to be reduced also because of the reduction in the fair value through profit, the fair value through P&L investments, which also reduced in value, isn't it? Where did they tell us that? Where did they tell us that figure of fair value through P&L? Wherever, let me read what I've written again. So they've told us that non-current assets have reduced because of the 11.5 million impairment on PPE, which is given to us here in note number 1, yes, and 2.1 million impairment on investments. Impairment on investments. Yes, it's there. Loss on remeasurement of financial assets at fair value through P&L. So you can see that it's a negative 2.1 million. So that's why our PPE would be affected because of those two things, right? So this reduces equity. Remember, your equity is basically your net assets, the total assets minus your liabilities, isn't it? So this reduces equity because the PPE value has fallen. And when equity reduces, the ratios dependent on equity also are affected, right? That's why you see part of the result. We see gearing is dependent on equity. So you can see that gearing increased. Although equity fell, gearing increased also. But that's also because equity fell because of these things, or PPE falling. But remember, equity is also affected by the shares, isn't it? And there was a rights issue, fully subscribed rights issue. So that would have increased the equity. And in gearing, debt also fell because we repaid part of the borrowings. But despite debt falling and equity falling, there was an increase. In the gearing. So that's because in the equity section, our PPE fell, but then there was an operating loss. So retained earnings would be lower. And also there was a rights issue. So all those factors would be the ones that cause the gearing to increase. Coming back to our position here, where were we? Okay, so asset turnover. Although equity reduced, asset turnover has increased from 1.5 times to 1.67 times because of all the reasons that I just discussed why equity increased, okay? Then if we look at your cash has increased by 2.2 million. We were told in note number 3 that cash has improved by 2.2 million. And that was because of our rights issue, isn't it? Which is fully subscribed. How much was the rights issue? Did they tell us the amount of the rights issue? They made a fully subscribed rights issue to help improve cash flows. We can know the value of the rights issue because we can look at the equity figures of 26 million this year compared to what they gave us, 24 million. 24 million was last year's equity. There was no share premium, but this year, if you look at equity is 26 and premium is 2. So equity increased by 2, share premium increased by 2. That's how I'm getting the rights issue, fully subscribed rights issue of 4 million, okay? So that shows shareholder confidence in the company. And part of this money was used to reduce the borrowings, which was sensible because we're on variable interest rates, isn't it? So we need to make sure that we reduce our borrowings so that you reduce the finance costs. Then there is a movement in retained earnings. And how do you calculate the movement in retained earnings? Remember, I was discussing that with you. The retained earnings of last year were 12 million. So if you mentally visualize your T account for retained earnings are 12 million, but then, so retained earnings is on the credit side, isn't it? And then the balance carried forward, that means retained earnings this year are 7.2 million. So 7.2 million on the debit side. And there was a loss. There was a loss, loss for the year reduces our retained earnings. So loss was 3.1 million. So 3.1 million would be on the debit side. So when you balance the account, the balancing figure that you get would be the dividend paid for the year. So that's how I computed the 1.7 million dividend paid. So the movement in retained earnings shows that the company paid a dividend, which they did tell us. And although this is only 55% of what was paid last year, this could seem unwise as we were discussing on that note, isn't it? But again, the directors may have done it to show confidence in the future recovery of the business. And the impairment losses affect the cash figures. So there is impairment. So aside of this movement in retained earnings, we did have impairment losses, but impairment losses do not affect cash. And that's why the liquidity of the company would not be affected, okay? So they've not really asked us for the liquidity ratios, but then it's another point you can mention in your analysis. Okay, where are we now? We're there. Working capital, coming to the working capital analysis, inventory and receivable days have increased. If you look at the last year, inventory holding period was 18 days. This year is 31 days. Receivables, we were taking 19 days to collect our debts. Now we're taking 27 days, and we're also taking much longer to pay off our suppliers. So all the working capital ratios have in fact gone worse, isn't it? But that's expected given the recession. So working capital has weakened because inventory and receivable days have increased, although revenue has fallen. But what could this indicate? This means that maybe the company is overstocked. And because what kind of a company is this? This is a fashion company. So that overstocking is dangerous. When your stock is not moving, your inventory days are increasing. That's dangerous for such people because then there is a risk of obsolescence, isn't it? So there's a risk of obsolete inventory because this is a fashion-related business. Sorry, give me a second, please. Okay, so we were on the working capital. We've said that inventory days and receivable days increased, although revenue has fallen. So you can see that revenue here fell from 72 million to 59 million. And despite revenue falling, it's taking us longer to recover money from our receivables, and our inventory days are also increasing. So what could this imply? When your inventory days are increasing, as we mentioned, it could imply that the business is either overstocking or and when the business is overstocking, another implication, given the fact that this is a fashion industry, we said that it's a problem for them because of obsolescence, when the stock fashion items generally run out of stock quicker. So that's quite a bit of a risk for them. And also the increasing receivable days mean that perhaps they're doing worse in their credit control terms. So the increase in receivable days suggests weaker credit control, or because of the recession, it could be that they have actually deliberately increased the credit period offered to customers to encourage them to continue buying. Payable days have also increased. So because of the strains in collecting money from customers, the company is also paying their suppliers late. So they've increased, as you can see from the calculations, payable days increased from 23 days to 49 days, almost over double, isn't it? So what does this imply? That we're paying our suppliers late. Coreg is paying its suppliers late. And this could affect the relationships with suppliers. Of course, they're not going to be happy that you're paying them late, isn't it? And then coming to the gearing part of it, we can see, if you look at our gearing ratio, we see that gearing has increased actually from 21.1 to 22.7. Yet they told us in the note that borrowings have fallen, isn't it? That bank borrowings have decreased by 1.5 million. And so if the debt part, remember the formula we use for gearing is debt over equity. So if debt has fallen, then we expect gearing to reduce. But also the reason why it's increased here is because the equity has fallen more sharply, isn't it? It has fallen not in proportion to the debt, but even more than the debt. And what are the reasons for the fall in equity? First of all, the revaluation reserve is gone. It's eroded. So that equity, the revaluation section, the equity is gone. And also, secondly, they are retained losses instead of retained earnings. So the losses have reduced, have taken up retained earnings down. And because of that, our gearing has increased. So what can we conclude about the overall performance? The results do look poor because of the recession. And if you take away the impact of certain one-off items, like we saw in the analysis, then the results look a bit better. And of course, for this company, we can say that they need to focus on improving their sales and working on their working capital management, because that's where we saw the problem. And there are one-off items like the impairment, which may reverse when conditions improve. But to get a clear picture about how this company is doing in the recession times, we need to compare its results with the industry averages to see whether the company is, sustaining and the impacts of the recession, have they affected others more, or is the company actually not being able to cope well with the recession? And that was your number done. That was your 4 marks for the calculations and the remaining 16 marks on the analysis. And that's your section C for this paper done, okay? Not challenging, like I said, the ratios questions, the answers are in the question, it's just how you utilize it. So give it a thought and organize it well. You, like we mentioned, like we discussed in the revision session, you know, whatever ratios you've been asked to calculate, obviously you're going to focus your analysis on those, but break down the line items. Like you saw for gross profit, we were talking about revenues, we were talking about cost of sales, because that's how the gross profit is computed, isn't it? So break down the line items and always look at the notes. The notes have told you the reason. So you're just supposed to put that in your analysis, okay? 16 marks, generally you expect 16 points. The number of marks give you an idea of the number of points they expect to see in your analysis. And they are there, they are going to be there, like you've seen, quite a detailed analysis, isn't it? So that is the end of our debrief here. Not quite brief, but yeah, that should give you more confidence now. And all the very best for your exam. And that brings us to the end of this session. Thank you.